Okay, let's dive in. When you think about real estate, what comes to mind? Probably, listings, open houses, maybe stressing over square footage or what the house down the street sold for.
Yeah, the usual stuff.
But what if I told you all of that is really just, well, the surface? Underneath, there's this powerful, complex economic engine. It's kind of the true heartbeat driving the entire market.
That's exactly it. It's
Right.
far more than just individual properties and specific deals. These larger economic forces are constantly at play, setting the rhythm, really, and they influence everything from national home price trends right down to, how buyers and sellers act in your local area.
And understanding that engine, that economic heartbeat, that's precisely what this deep dive is all about today. We've been sorting through a pile of sources, research papers, market reports, articles covering everything from forecasting house prices to basic economics, business cycles, real estate cycles, market outlooks, the works.
Right. And our goal here is really to boil down the key takeaways from all that. We want to take these concepts that might seem a bit abstract, things like supply and demand, market cycles, interest rates, and show you how they are the absolute fundamental drivers. They shape, well, every corner of the real estate world.
Because truly, getting a grip on these forces is what elevates you, isn't it? It moves you beyond just, say, participating in the market or handling a transaction. It empowers you to become a genuinely informed market advisor, someone who can actually read that underlying pulse and offer strategic, adaptable guidance.
And to understand that pulse, that heartbeat, we really have to start with the most foundational pieces of, well, any market, supply and demand.
Right, back to basics. Our sources lay these out pretty clearly. Think about supply. It's essentially the quantity of something could be houses, office space, industrial warehouses that owners or developers are willing and, importantly, able to sell or rent out at a specific price over a certain time.
And then you've got demand. That's the other side. The quantity of that same real estate that consumers, home buyers, renters, businesses needing space are willing and able to buy or lease. And the dance between these two is governed by those really fundamental laws.
Which kind of feel obvious once you say them out loud. The law of supply basically says, look, if the price for something goes up, producers are generally going to supply more of it.
Right.
They're incentivized by the higher potential return. Makes sense if homes are fetching top dollar, builders build more, maybe more owners decide now's the time to sell.
And the law of demand, naturally, is the opposite. If the price climbs, the quantity people want generally falls. Folks buy less when it costs more. And the reverse is true, too. Lower prices tend to boost demand. Like a sale sign drawing people in.
Simple enough in theory. And that magical point where the amount supplied perfectly lines up with the amount demanded, that's called the market clearing price, or equilibrium. It's the theoretical sweet spot where everything's balanced.
But, and this is a big but for real estate, as research by Case and Schiller showed way back in the late 80s, early 90s, the real estate market isn't perfectly efficient.
Okay, so what does that mean practically for us on the ground?
It means prices don't always snap into place instantly based on new information. Real estate markets, they have momentum. Price changes can actually trend in the same direction for several years. That's a classic sign of a less efficient market. It happens for lots of reasons specific to real estate. It's not liquid like stocks. Transaction costs are high, and psychology, fear and greed plays a really big role. So yes, supply and demand are fundamental, but their impact isn't always immediate or perfectly neat like in, say, a stock ticker.
That momentum idea definitely helps explain a lot of what we actually observe. Now, applying these core principles, supply and demand, directly to real estate, our sources give some really potent examples, sometimes pretty stark ones, actually.
Oh, absolutely. Take residential housing. The CAR forecast we looked at explicitly called out persistent housing shortages. I mean, that's a textbook case of low supply compared to demand as a primary reason for the significant upward pressure we've seen on home prices. It's Econ 101 playing out right in front of us.
And Matt Shupner, an economist at U.S. Bank, he backed this up, pointed out that the supply of homes actually for sale has stayed stubbornly tight. We're talking levels just barely above the record lows we saw during the initial shock of the pandemic. That incredibly tight supply is a huge force holding prices up, even when other economic signs might suggest things should cool off.
And demand isn't static either, right? The introduction to demand and supply source reminded us that what people expect to happen in the future is massive. If potential homebuyers look ahead and see maybe a shaky economy, or if they start thinking prices might actually fall soon, well, they're likely to put off buying. That hesitation directly cuts down demand in the market right now.
So it's not just today's conditions, but what people think tomorrow might bring that changes behavior today. That's fascinating. What's also really interesting is how differently these supply and demand forces show up across different property types, like the Crexi report detailed.
Yeah, that report painted a great picture of the variations. Look at the industrial sector. There was this huge wave of construction, a record amount coming online, especially late 2023. That's a massive injection of new supply. So even though the long-term demand drivers like e-commerce and consumer spending still look positive, that sudden flood of new space hitting the market all at once is now potentially slowing down rent growth.
Yeah.
Too much supply, short-term anyway, shifts the balance, even if underlying demand is still pretty decent.
Right, it's about the rate of change, how fast supply comes online versus how fast demand grows.
Hmm.
Now, contrast that with the office sector. It's facing some serious challenges. Even though, interestingly, the number of actual office jobs has gone up since 2020, the way people work has changed remote, hybrid models. That means companies need drastically less occupied physical space per worker.
Exactly. That's effectively a huge drop in the realized demand for office square footage. And the Crexi report noted this has hammered asset values. Then you layer on economic uncertainty. It just makes it worse. In this case, demand fundamentally shifted because of how we work, leaving all these existing buildings, the supply, way outstripping what's actually being used.
And then you look at retail, which that same report mentioned is showing resilience. Why? Because healthy consumer spending is boosting demand for retail tenants. Businesses want to be where the customers are, where they're spending. So strong tenant demand is helping keep that sector relatively stable. It's the same basic forces, supply and demand, but different specific factors in each sector leading to totally different results.
Precisely. Understanding these different stories, seeing how supply and demand play out in industrial versus office versus retail, that's crucial for making sense of it all. It's not just one big real estate market. It's a collection of submarkets, each with its own supply and demand narrative.
Okay, so we've got the basic push and pull, supply and demand. But the market isn't static, right? It doesn't just find that balance point and stay put. It's always moving, going through different phases, different cycles.
Absolutely. Economic activity in general, it doesn't move in a straight line. It ebbs and flows in cycles. The standard definition of business cycles is these periods of economic expansion followed by periods of recession.
And real estate markets have their own quite distinct cycles, often described as following this continuous sort of wave-like pattern. You could think of it as the market breathing, its own rhythm.
And this real estate cycle is commonly broken down into four key phases, which are sources, especially the CrowdStreet material, laid out nicely. First up, you have recovery. This is when things start picking up again after a downturn. Demand begins to maybe tentatively increase, but there's usually still a fair amount of supply hanging around.
Okay, then after recovery comes expansion. This is the phase where demand really starts to accelerate, maybe even starts outpacing new supply. You see vacancies dropping, rents climbing, and potentially hitting new highs for both rents and property values.
And the expansion phase, it's often noted as being a prime time for certain investment approaches. Things like developing new properties, or strategies called core plus and value add, basically buying properties that need some work or repositioning. Why then? Because when demand is strong and space is getting absorbed quickly, you have a better shot at making those riskier but potentially higher reward projects work out.
Makes sense. If demand is robust, you feel more confident you can actually lease up that new building or fill the renovated space. But expansion can't go on forever. Eventually, all that building and fixing up starts to catch up.
And that leads into the next phase, hypersupply. This is the point where the supply of new construction or available space starts growing faster than demand is growing. The market isn't necessarily crashing yet, but the balance is definitely shifting. Supply starts to get heavier than demand. You might see vacancy rates start to edge up a bit, or rent growth slows down noticeably.
And if that imbalance keeps going or gets worse, you tip over into the recession phase. Here, supply clearly outweighs demand. Vacancies rise more significantly. Rent growth might actually turn negative or at least fall way behind inflation. And building operators, they often have to start offering concessions like free rent or just straight up reduce rents to get and keep tenants.
Interestingly, though, even though it's called recession, this phase is often pointed out as a good time for opportunistic buying. That means snapping up distressed assets properties that are really struggling, maybe the owners are in financial trouble, and you can potentially buy them at a steep discount.
So buying when other people have to sell, maybe way below what it might normally be worth.
Exactly that. But, and this is key, it requires a patient approach and deep pockets, a well-capitalized plan. Because you'll likely need to hold on to that property, maybe invest even more into it, and ride out the rest of the downturn until the market eventually starts recovering again.
Understanding these four phases, recovery, expansion, hypersupply, recession, it's not just, an academic exercise. It gives you a really crucial framework for making strategic calls. Knowing which phase you think the market is in totally changes how you might advise a client or how you'd invest yourself. When to buy, sell, build, it reframes everything. You're not just reacting to today's news, you're trying to place today within that larger cyclical rhythm.
It adds such a vital layer of context. It helps make sense of the noise. Now, layered on top of these internal market dynamics, the supply-demand balance, the cycles, there's a huge external force that has immense sway over real estate, interest rates.
Ah, yes, the big lever, the one the central banks use that seems to ripple through everything. How do interest rates hit real estate specifically, based on what we read?
Oh, they're absolutely critical. I mean, central banks use interest rates as their main tool to manage the whole economy's money supply and try to control inflation. But for real estate, the impact is incredibly direct, really tangible, mostly affecting affordability and just general market activity levels.
Affordability feels like the most immediate one for home buyers. That U.S. bank source had a pretty eye-popping number. The median monthly mortgage payment back in May 2025 was $2,860. And that's based on average 30-year rates and median home prices then.
Yeah, and Matt Schattner, the economist there, also noted that the chances for that affordability picture improving significantly didn't look great at the time. When payments are that high, it just flat out prevents a whole chunk of potential buyers from entering the market. It directly caps demand no matter how much they might want to buy a home.
Right. If people can't swing the monthly payment, they can't buy. Doesn't matter how many houses are listed or how much they wish they could. Simple as that.
But flip that around. A move towards lower, more favorable interest rates, that can change the dynamics pretty dramatically. The CAR forecast specifically talked about how lower rates could ease the lock-in effect.
Right, the lock-in effect. That's where homeowners who snagged those super low mortgage rates a few years back are really hesitant to sell and buy something else because getting a new mortgage, even on a similarly priced home, would mean a much, much higher rate and therefore a much bigger monthly payment.
Exactly. They feel kind of trapped by their great rate.
Ah.
But if market rates start to come down, the gap between their current low rate and a potential new rate shrinks. That makes selling and moving seem more palatable, potentially unlocking more inventory as these homeowners decide to list their properties. More homes for sale means more supply.
And more supply, combined with buyers having better affordability because their borrowing costs are lower. Well, that encourages activity on both sides. It can really grease the wheels of the market, boost sales volume, and maybe even support prices because more buyers can now compete. It's like this cascade starting from just that one lever, the interest rate.
And tying interest rates back to the bigger picture, these changes don't just impact mortgages. They influence overall demand in the economy, job growth, wage increases, all of that stuff. And those factors then circle back and affect how prices are set everywhere, including housing costs and rent, which, as our sources noted, are actually major components driving overall inflation figures.
It really is all connected, isn't it? And one really interesting predictor tied to interest rates that popped up in the sources is the yield curve, the difference between short-term and long-term interest rates.
Yes, the yield curve. It's watched very closely because it's seen as a pretty powerful predictor of where the economy might be heading, future growth, inflation, even recessions. An inverted yield curve, that's when short-term rates are actually higher than long-term rates, has historically been a pretty reliable, though not perfect, signal that a recession might be coming.
And for real estate, a potential recession means, well, slower economic activity, maybe job losses, definitely less consumer confidence, all things that tend to dampen demand, potentially push up vacancies in commercial spaces, and generally put downward pressure on property values. So, keeping an eye on the yield curve is another piece of the puzzle, another signal for reading those underlying economic conditions relevant to real estate.
Absolutely. It's another indicator to watch when you're trying to gauge that market heartbeat.
Okay, so let's try and tie this all together then. We started with the real basics, the bedrock, supply and demand, that constant push and pull setting the stage for value and quantity.
Then we laid on the idea of cycles recognizing the market isn't flat, it moves through these distinct phases: recovery, expansion, hypersupply, and recession. each with its own feel, its own opportunities and risks.
And then we brought in interest rates as this major external force, hitting affordability directly, messing with inventory through things like the lock-in effect, and just generally being a key tool for managing the whole economy, which then feeds back into everything else.
And we touched on how inflation, partly driven by housing costs itself, is also woven into this complex tapestry. Understanding how all these different pieces, supply-demand forces, where we are in the market cycle, the direction of interest rates, how they all interact and influence each other. That is the real skill. That's reading the market's heartbeat.
It's not just about looking at one listing's price or the last sale down the block. It's about seeing the deeper economic currents that are shaping why prices are where they are, why inventory is what it is, and who is actually in a position to buy or rent right now.
And that deeper understanding, that's what allows you, as you said earlier, to move beyond just being a facilitator. It lets you become a strategic advisor, someone who can offer guidance that's adaptable, that's informed by the bigger picture, not just a single deal right in front of you.
You become someone who doesn't just know the market stats, but actually understands the why behind them at a much more fundamental level.
So we've done this deep dive into these core economic engines driving real estate, that crucial relationship between supply and demand, the kind of predictable rhythm of market cycles, and the huge influence of interest rates.
And grasping these concepts, it really is incredibly valuable for anyone involved in real estate or even just interested in it. It takes a lot of the mystery out of the day-to-day movements and equips you to make much more informed decisions or give much better advice because you can see the underlying mechanics.
And yet, despite all this knowledge, and even with sophisticated forecasting models, our sources do remind us that predicting the exact turning points in the market, that's still really, really hard. Business cycles can get knocked off course by unexpected shocks, things that seem random.
So, given that inherent uncertainty, that difficulty in nailing the exact timing of when the market shifts, what does learning to recognize these underlying economic forces really empower you to do differently? How can you use this understanding to navigate better, despite the fact that you can't perfectly predict the future? That's maybe something worth mulling over as you take this understanding of the market's heartbeat out into the world.